Self-managed super funds, it's one of those topics that is so damn confusing. Super itself is pretty confusing, but should we be the ones managing it? But is it actually that confusing? So we just did an incredible live session that you're about to watch with Bernadette Christie-David. Why do we want to get her on? Because she is both an accountant and a mortgage broker. So she can talk to all of this stuff. For the next hour and a half, we absolutely pepper her with every single question that you could ever think of from a self-managed super fund perspective. You get to sit on there and watch and listen to her unpack self-managed super funds and how this whole thing works. It is incredible the amount of leverage that you get, the amount of opportunity that you get with a self-managed super fund, and you actually don't need that much capital to get in. We also, at the end of the video, start talking about trust structures and how we can create some opportunities around trusts and lending to be able to continue our property investing journey. So this is an unreal session. So anyone that is not a part of this community, like and subscribe, and you will get notified straight away. Hey everyone, my name is Joe Tucker, and together with Jeff Miles, we create Australia's largest property investment group called Oz Property Investors, and we have over 75,000 property investor members, and together we are all growing and learning on our property journey. And each week we interview top property experts, exactly like Bernadette, and we can unpack their key learnings so that we can continue our property investing journey and make this stuff happen. It does not have to be complicated, does not have to be complex. You can do it. You just need to learn from the right people, and that's what this session is all about. Let's jump in. Consider the lending requirements for a business. So you generally you can't borrow to buy property for about 12 months. So you need to have at least 12 months financials, and then sometimes it's 2 years worth of financials. Actually, Bernadette, why am I saying this? You're the broker. What do you typically see from a broking perspective of brand new businesses that have just started up to when they can eventually start to borrow? So if that person out there does have that new startup idea, how do they think about it as in that property journey?
Totally. So the banks need to see the ABN have been registered for at least 18 months. So that's ABN registration. And there's a new policy, or I'd say relatively new policy that's come out. And it's referred to as either simple verification for self-employed or director's wages. So the banks don't actually need to see any more tax returns and financials of the business. But if you can prove to them that you've been paying yourself a regular and consistent wage from your business to yourself, then they'll actually take that 6 months evidence, annualize it over 12 months, and then they'll give you borrowing based on that. So as long as your ABN's at least 18 months and you've paid yourself 6 months and it's legit, like proper payments, lodging with the ATO, then you're good to go. So it's not as hard as it used to be. It did used to be 2 years of tax returns, then 1 year, and now this 6 months policy is a really exciting one.
Wow, that's super interesting. Yeah.
Is that with a self-employed specialist lender, I imagine? Or is that with a major lender? We can get that with?
That's with a major lender. We're not talking low doc. This is full doc lending with big four banks. This is legit.
What's currently happening in the lending space? What is sort of what's working, what's not working?
Great question. So I mean, we're in a position where we all know rates have increased substantially over the last 12 to 18 months, and people's borrowing is stretched. So when we're in that position, I think it's really important for you, looking at your portfolio, understanding where you sort of sit in the tier of lenders, because there is a tier of lenders. So typically, good brokers will be taking you to the big four banks. So think your CBA, ANZ, NAB, Westpac, right? They're taking you there first. They're maxing out your borrowing power, releasing any equity, getting your approvals to go again. Then if you look at your second tier of lenders, still mainstream lenders, but you're looking more like possibly Macquarie, AMP. They have some more generous policies when it comes to bonuses. Sometimes they look at 1 year worth of bonus income. So that's really important to know if you've maybe started a new role and you only have one bonus instead of most lenders need to see evidence of 2. So that's a really good little strategy there. And then if we've looked at that second tier of lenders and you're maxing out again, you are then looking at your third tier lenders. So that would be like people would know, your First Max, your Latrobes, Peppers, Liberties, all that sort of stuff. And understanding where you sort of sit in your portfolio and what lender you are with will give you a bit of an indication as to, okay, where am I at in my borrowing? So I spoke to someone this week and they're like, I'm fully maxed out. And I went, okay, great, let's talk through your portfolio. They had 4 properties. They were all with St. George. And I look at that as a seasoned broker going, dude, you've got power. If you're all with St. George, you're still in that first, second tier of lenders. If we really want to keep going, we can go down and keep going again. Of course, moving to the third tier of lenders, you do have higher rates and higher fees, of course, but something to be mindful of where you sit in that scale.
I particularly heard that with the big 4 kind of banks, that they've just sort of not wanted to continue, and subsequently they've sort of increased the rate, and they're not negotiating on it. They're just saying, well, this is the rate that you're going to pay, and yes, it may come down when and if rates get cut, but that's what I've sort of heard as well.
That's definitely what I'm seeing for SMSF lending. So 4 or 5 years ago, all the big banks used to do it. They used to give SMSF loans. They stopped 4 or 5 years ago. But what they've done is they've kept their rates as they are. So a lot of people who still have SMSF loans with the big 4 banks, with St. George, Macquarie, their rates are looking like you're around 9 or 10%. If you have an SMSF loan that's with one of those lenders, please refinance immediately. There are other lenders that are offering much lower rates. You can save yourself a heck of a lot of money.
So SMSF, what is it? How does it work? Like, give us, if somebody's not heard of it before, start us from the beginner and we'll sort of progressively add layers to it.
Perfect. Yes. So SMSF, it stands for Self-Managed Superfund. So instead of you putting your super contributions to a retail or an industry fund, like Australian Super, Aware Super, something like that, you actually create your own fund. You set it up, you manage it, and you administer it. You are responsible for it. So why is SMSF getting popular now? The people that I speak to, there's 2 camps. I'll speak to the first camp. It's the people who have picked up their balance from 30 June or coming through soon in the next 3 weeks. They then look back to their balance 3, 4, 5 years ago, and despite the super contributions that they've been putting in every month, the balance is not growing as quickly as they thought. And we are in bull market everywhere. And people are going, what's going on? I'm missing a trick. They delve a little bit deeper and then they just start to think, and we had this discussion in our pre-chat, who is going to manage your money the best for your retirement? In my opinion, I don't think that it's necessarily going to be those fund managers or those account managers. It's you. You know, you can see yourself in that income that you'll be able to receive when you retire. And then when I start to have those discussions with people, they get really excited and they're thinking, actually, you're right. Like, this is something that I've never thought about before. It just goes away in the side. And now when I look at it, it's like so obvious that there's a trick that we're missing. So what can you do with your SMSF? Again, this is not financial advice. This is just us having a chat. So what can you do? Once it's set up, you can invest into anything that you want. Shares, managed funds, index funds, property.
Even crypto.
And crypto if you want. You can do art. You can buy art. You can buy gold. The choice is yours. You have to act in a responsible manner for the beneficiaries of the fund. So that'll be you and whoever you set up this SMSF up with. It previously was that you could only have 4 members in an SMSF. You can now have up to 6 members in an SMSF. So it could be possibly, you, your partner, your brother's partner, and, you could sort of combine balances and have 6 balances in there to go out and buy whatever you want.
I'm gonna say, from a lending perspective, what does that sort of look like if you start combining sort of people that may not be in your household, as in you've got your brother, your sort of cousin? What does that look like? Does that start to get a bit messy, or how does that work?
It's not messy, and that's what I love about SMSF lending. It's so easy, and that's what I want to. This is a myth I want to dispel tonight. It's if we look at an SMSF on its own, so the lender will look at the SMSF, the little circle bucket, who the members are. They'll look at the super contributions that are coming into the bucket every month. They'll look at the rental income for the property or the properties that you will buy. Add that all together, times it by 9, and that will roughly tell you how much of a loan you will get from the bank. It's that simple. So if you've got, say, 4 people in your 4 people in your super fund, take everyone's super contributions for the year, add in the rental income for the property you want to buy, total that up, times it by 9, and it'll tell you roughly what the bank will give you in terms of a loan. It's that simple. You can calculate that on your own.
What are the not so benefits of it? What are the downsides of an SMSF?
Disadvantages, yeah.
Disadvantages.
Yeah, disadvantages. I mean, it's locked in there, right? If you've got a property outside of super, you can at any point go, I'm going to sell it, I'm going to take the cash, I'm going to pay off my owner OC.
Yep. Buy a nice car.
Buy a nice car, buy a boat, go to the Maldives, whatever the dream is. If it's in super, it's there until you reach the preservation age, or unless there's extenuating circumstances. At the moment, preservation age by the ATO is 60. So you have to reach 60 before you can access those funds. Being mindful though, like for us, I think the preservation age will go up. So we're all living longer, and yeah, it's going to have to. So yeah, just being mindful of it, that will go up. What are the other disadvantages? I mean, I'm trying to think, because obviously I'm a very passionate SMSF enthusiast.
Can I throw one in there?
Yeah, please, Jeff.
We're really big. We love a good renovation here in Oz Property. We Joe and I are both. That's probably the one thing that would concern me a little. Not concern me, but would restrict me somewhat. But I suppose then I could buy my reno properties outside of super. Because is there a way you can't necessarily improve a property? You can bring it back to the original, or not original, but you can repair stuff, but you can't improve it. Is my understanding correct? And that's the right. Sole purpose test. Is that? I mean, am I getting that right?
So it's called the single acquirable asset test by the ATO. So it is a mouthful. The ATO loves lots of words. We can't do any structural renovations to properties in SMSF. So we can do repairs. They're totally fine. Think new paint, new carpet, new roof, even something like that. We cannot do structural. We cannot add a bedroom. We cannot add a bathroom. We cannot do construction with lending. So that's where it gets a little bit restrictive.
Yeah, because you can put a granny flat on the back of your property, but most people get a granny flat and they lend and borrow the money to put a granny flat on. But in an SMSF, you cannot borrow extra funds to be able to do that. So it has to be from the cash contribution. So you have to have, 200K cash to be able to add that extra value. What about subdivision? Like if we buy the block, knock it down, subdivide it, split it into 3 blocks, build some units on that, can we do that type of thing?
My understanding is no, but please check with your accountant. And the reason is because the ATO sees that as you carrying on a business and like creating property or subdividing property to create wealth and running a business. So that's a no. And then the other one is that's a big downside is we cannot release equity from a property in SMSF. So say we buy a property, 80% loan, and we're paying it down, it's principal and interest over 30 years, and we get to 5 years' time, we've paid it down a bit, but the value's grown. You cannot come to me and say, Bernie, I now want to release some equity. I will say, no, not allowed. So that's why I think for SMSF, one, the loan structure and the loan strategy is super important. We really do want to try to get you to maximize that lending at the beginning. So sitting at that 80% LVR, because we cannot release any more equity beyond that. And then also the property strategy. And you guys would know this. If it's in an SMSF, we do want it to be a fairly good quality stock property. We don't want it to have too much work that's going to need to be done to it. We can claim depreciation. So if it's a newer property, there's going to be more depreciation we can claim. So property strategy, loan strategy is going to be super critical for the SMSF. Let's say we want to buy a $500,000 property in super, okay? Mm-hmm. We want a 20% deposit, that's $100,000. Yeah. We want to pay stamp duty, which is about 18 in Queensland, and we're paying bank and legal fees of about $5,000. So a little bit more, but it's a one-off. So all up, $118,500, that's $123,000 that you need to kick in to make a $500,000 property work. So I'm seeing people, if you've got that balance of 130 to 140, you can buy a good quality property at 500. I am also still talking to people who have a balance of about 120, and we're trying to see how we can get that 450 purchase work for them as well. So people with as little, I'm talking to people with as little as 120,000 that are like, I'm in, I need to make this happen.
Is there a limit of properties you can have in your SMSF, or is the limit based on the total value of the SMSF?
Great question.
That's a great question. So you're limited by your super balance, and so because that's going to make up the 20% deposit, cover the stamp duty and costs. So whatever your super balance
is. From a bottom standpoint, we're limited from like the bottom standpoint. Okay.
Yep, correct. And then you're going to be limited by your contributions and then the rental income from the property, because at some point you will reach a limit. But I mean, it really depends on your personal position. Like I'm speaking to some clients who have, they're in a very good position, 700,000 sitting away, planning to do, 3 properties at once. So yeah, it's very individual.
There's another question that popped up. What is the maximum limit of assets or cash allowed in an SMSF before it gets affected by the extra tax and charges? I heard someone say a figure of $3 million. Do you know anything about that? It's a very much an accounting question. So if you don't know the answer.
It is an accounting question, but yeah, the ATO passed some new legislation this year about the tax rate. So once your assets reach, I believe it is $3 million, then there are some different tax rates that are involved. Definitely one to speak to your accountant about. But remember, we have to get our asset position to a $3 million base before that comes an issue. And then if it is an issue, well, we're only paying up, from what I understand, 30% tax anyway on the additional income past the 3 mil.
That's a good point. I want to know, because I don't think we've really touched on this. It's about time frame to set up an SMSF. I imagine there's more time and more paperwork, more admin. We all love admin, but it's all part of the process. So what does it take generally for an SMSF to be kind of worked through from a broking perspective?
Yeah, I mean, I'd say it'd be 6 weeks would be the time frame, and I can give maybe a quick overview or a roadmap of what that would look like. You would speak to your broker first, and you'd find out if you have the borrowing to purchase what you want to purchase. Then when you get the green tick, you go into your accountant, you're setting up the SMSF trust and the corporate trustee, if that's the structure that you're going for. When we have those details, you then can set up your SMSF bank account. So you're literally going to have a bank account. You're going to request the rollover from your current Superfund into the SMSF bank account. So you're literally going to have a login detail and be able to see those funds sitting there. And then during that process, we are applying for the pre-approval and making that happen. So if you're moving quite quickly, if you've got all your paperwork and following up that circle around you, then I'd say 6 weeks, and I've seen people do it quicker than that as well. Typically, what takes the longest is the rollover from your retail fund or your whatever fund you're with. They don't want to lose you, so they like to delay that process. It's usually sometimes 3 to 4 weeks, even though it's meant to be a bit quicker.
How does the Bear Trust come into all of this?
Yeah, that's a great question. I really wanted to talk about that because it's I think once people understand the structure of their SMSFs and the entities that they're going to have, it makes the whole thing a lot easier. So we've already spoken about the SMSF on its own is the circle, it's the trust, and then it's the corporate trustee, the triangle that sits above it. So what the ATO said is, okay, we'll let you guys borrow money to buy property, but we want to protect any assets that you have in your SMSF. So to do that, we're going to make you set up a second trust called a bear trust or a custodian trust. So the whole purpose of that is to hold the property that you buy. That bear trust is going to also have a corporate trustee above it. So why has the ATO said that? So let's say, I'm going to talk like a very worst case scenario. Say in your SMSF, back to the first trust, you and your partner both lose your job, your super contributions stop coming in. Your rental income for the property stops because the tenants have trashed it. Then you deplete all your money in the SMSF. The bank is going to seize that property, right? And this is assuming you can't sell it because the property's been trashed and you don't have insurance. The lender is going to seize that property and they're going to sell it and they're going to clear their debts.
Okay.
The ATO does not want that lender to then also to be able to come after any other assets that you would have in your SMSF. So if you've got shares sitting there, cash, crypto, art, whatever it is. So it is to protect you. It is to protect everything else that you have in your Superfund.
Let's get through structures and trusts. What is the key differences, I suppose, between self-managed super fund and trusts and structures? I can imagine a couple, but from a lending perspective, what does it look like?
Yeah, so I mean, it is actually really similar to what we've spoken about. It's just outside of super. So you can have the same structure, that trust structure outside of super with a company trustee. You have the trust as the borrower and the purchaser of the property. Now, the real benefit of that structure outside of super is once that trust is trading profitably, so once the rental income is meeting the commitments of the interest, the water bills, rates, everything related, and your accountant will give you an accountant's letter that says this trust is trading profitably and able to meet its commitments. Say that loan's with CBA, we could go to another lender and we provide that accountant's letter and then do not have to declare that loan. So it is another structure and something we're talking a lot with our investor clients about, because if you can buy the right property, at the moment it may not be cash flow positive, but when rates are coming down, if you've bought the right properties, it could be close to that. And your accountants are going to write you that letter. We can put the lending in those trusts, and I don't want to say hide it, but in a way hide it and go out to other lenders and go again.
I think rather than hiding, because I think it's more about considering that it's paying for itself. So essentially, you don't need to factor it in because it's not going to give you a concern. That's the way I like to think about it.
Not going concern.
Not going to give you too much of a concern if it's already if it's fairly positively geared or positive.
That's a great way to describe it, Jeff. And the reason why we're comfortable with that is because when lenders take loans into their serviceability calculations, they're never taking the interest rate as it is. So say, Joe, you've got that property you've just bought, it's at 7.29%. They're not putting 7.29% in your calculator. They're adding a buffer to that, usually of 2 or 3%. So they're calculating that you're making that loan repayment based on 9 or 10%. It's just not accurate, right? So if we can just get that letter, say it's taking care of itself, it's washing its face, then we can move on to the next one.